All right, let's talk about this market, because honestly, it's sending some seriously confusing signals. On one hand, you have inflation that just won't seem to quit. But on the other, the economy feels like it's starting to hit the brakes. So, what do you do? Well, today we're going to cut through all that noise. We're going to tear apart a real institutional strategy report, piece by piece, to see exactly how the pros make sense of all this chaos. And that really is the million-dollar question, isn't it? With so much conflicting information flying around, how do professional investors find a clear path forward? Well, the secret is they have a playbook, a structured system for analyzing the market from the top down. And today, we're going to walk through that exact playbook together.
So here's our roadmap for today. Think of it like we're building a pyramid. We're going to start with the huge wide base, the big picture, that macro storm that's brewing. Then we'll move up to look at the market's foundation in bonds and currencies. From there, we'll climb up to the stock market and its hidden fragility, then see where the big money is actually flowing. And finally, we'll get to the very peak, the strategic choice between two very different futures.
Okay, let's dive right in at the base of that pyramid, the big picture. Right now, the core conflict, the thing driving absolutely everything, is this epic battle between rising prices and a slowing economy. This is the central tension we have to get our heads around. This right here frames the market's core problem perfectly. It is caught in a brutal tug-of-war. In one corner, you have inflation making an unwelcome comeback, and in the other, economic growth is sputtering out. And when you get both of those nasty things at the same time, you get the dreaded S word, stagflation. And the data is telling us it's not just a theory anymore. And here's the proof on the inflation side of the story. 16.8%. That is not a small number. It's a shocker. That's the annualized jump in the prices of things we import, driven by stuff like oil. It's a massive warning sign that inflation is getting sticky again, and you can bet those costs will eventually find their way to all of us.
Now, for the other side of that tug-of-war, the growth picture is getting darker. I mean, just look at how aggressively the big banks are raising their recession forecasts. Moody's is now calling it basically a coin flip. This isn't just noise, folks. It's a clear signal from the people with the most at stake that the risk to the real economy is growing, and it's growing fast.
Okay, let's climb to the next level of our pyramid. Now we're looking at the very foundation of the entire financial system. We're talking about government bonds, which set the price of money for everyone, and the US dollar, which is basically the plumbing for the whole global economy. This chart is sending up a huge flare. See those primary dealers? You can think of them as the buyers of last resort for government debt. They're basically forced to buy it if no one else will. So when their share of an auction jumps this high, it's a screaming signal that demand from private investors is drying up. It's a subtle but really serious crack in the financial foundation.
So why is bond demand so weak? A big part of the answer is this kind of wonky concept called the term premium. But really, it's just the extra pay that investors demand for the risk of locking up their money for a long, long time. And with so much uncertainty about inflation and debt, that premium is rising. That structurally pushes up long-term rates for everything from government borrowing all the way down to your mortgage.
Now let's talk about the dollar. The best analogy the pros use is the milkshake or straw effect. In a world full of fear and uncertainty, money runs to safety. A strong US dollar acts like a giant financial straw, just sucking capital and liquidity out of every other country and into the relative safety of the US.
And the data absolutely backs this up. The dollar index, the DXY, is holding strong. Now, a strong dollar might sound like a good thing for the US, but it puts immense pressure on the rest of the world. Right now, it's pretty much the only game in town for global money looking for a safe place to hide, and that tightens the financial screws on everybody else.
Okay, time to move up the pyramid again. We've seen the microstorm. We've seen the cracks in the foundation. Now, let's look at the stock market. Because the daily headlines might show some nice gains, but when you look under the hood at the market's internal plumbing, its microstructure, you see a system that has become incredibly fragile.
This statistic is it's astounding. Think about this for a second. Nearly 2/3 of all the betting on the direction of the S&P 500 is now happening on bets that expire that same day. These are called 0 days to expiration options, or 0 DTE. This has basically turned the market into a casino, and it's what creates these massive, unpredictable swings during the day that are based on technical flows, not fundamentals. And here is the really dangerous side effect of all that gambling. It has basically destroyed the market's natural shock absorber. There's this technical state called negative gamma, And all you really need to know is it forces market makers to sell when prices fall and buy when prices rise, which just amplifies every single move. A tiny little piece of news can now trigger a violent mechanical chain reaction. And this quote from an institutional trader just perfectly captures the cynical reality on the trading floors right now. They don't see these sharp rallies as a sign of a healthy market. They see it as a pain trade, a technically driven, forced rally caused by short sellers getting squeezed out of their positions. It suggests the recent strength is really just built on a house of cards. So, in this complex and fragile environment, where is the smart money actually going? Let's move on up the pyramid and track the flow of capital across all the different sectors.
This scorecard tells a very, very clear story. The money is flowing out of things that depend on a happy consumer and low interest rates, like cloud software and consumer goods. And where's it going? It's going into the hard stuff, physical energy, the tangible hardware that powers AI, and the defense sector. It is a classic defensive rotation.
So if we were to build a portfolio based on where the big institutions are placing their bets, what they call being overweight, this is what it would look like. It's all about tangible assets and safety, AI hardware, defense, commodities, and the safest government debt you can find. And above all, just holding plain old US dollar cash. This is a portfolio that's built for inflation and uncertainty.
We've now reached the very top of our pyramid, strategy. After analyzing the economy, the bond market, and the stock market's weird internals, it all comes down to this. The pros see the market as facing a critical fork in the road, with two very distinct futures ahead.
And here are the two paths. It's fascinating because they seem to hinge on a single geopolitical trigger. In the bull scenario, peace talks in the Middle East succeed, oil prices collapse, inflation fears just vanish, and the market rallies hard. But in the bear scenario, the talks fail, oil spikes through the roof, corporate profits get crushed by high costs, and the market falls significantly. The outcomes just could not be more different. But professionals always have to consider the tail risk, that low probability event that would have a catastrophic impact. The true black swan here is a direct military conflict that completely paralyzes the global oil supply. This wouldn't just be a price spike, it would be a systemic event that could trigger a global fire sale of all assets, dwarfing those other two scenarios.
So what's the final verdict? A neutral rating. The report concludes that while the market isn't collapsing, its stability is basically an illusion. It's being propped up by those weird technical factors we talked about, while underneath, the structural risks in the economy and the bond market just continue to build. Caution is absolutely the key takeaway here.
We'll end with this great piece of market wisdom. It perfectly captures the essence of our entire analysis today. In a market that is this technically driven and this fragile, sentiment drives everything. Rallies are born from fear, and corrections begin with greed. It's a powerful reminder that in today's market, understanding the underlying structure isn't just an academic exercise. It's everything.